Over the past few weeks, we've been keeping quite a close eye on the European situation and keeping a close eye on European bonds, contagion risk, worries about Greece and any potential knock-on impact to other countries. And it's something that has been in the background, suppressed and not necessarily determining the direction of these markets. That is until really the last week or so, when the European situation has very much taken centre stage. The story at the moment is all about Greece, the impending need for cash, the impending need for redemption of bonds is creating a scenario which is still under much confusion as to how or which is the correct way of resolving the situation. And that sentiment is having quite a big impact on financial markets, as we'll see through the next set of charts. So let's start with the Greek bonds. This is the 10-year bond, the yield that is payable on a 10-year bond, and really, as we can see here, from the beginning of 2011, January, February, started to step up in April, and this really coincided with when stock markets started to turn lower. And what we've seen here is a very sharp increase in the yield on 10-year Greek bonds that clearly is now beginning to forecast what we believe to be about a 75% risk of a default into the price of those bonds. Let's just have a look at some of the other bonds in Europe, or in particular Spain. While Spain is not necessarily considered to be a big risk, it is the situation that lurks in the background of all of this. Depending on how Greece is resolved, naturally there will be they're looking at the Portuguese situation and the Irish situation, and then would that have an impact on the Spanish situation? And this is the yield on Spanish bonds. We can see here that having sort of hit this level of around 5.5% on Spanish bond yields through the course of 2011, there was a pop-up into new high territory last week. So we're certainly not in emergency area for Spain, but it is a chart that's breaking to the upside. And the higher that chart goes, I'm afraid to say, more negative sentiment that is going to be impacted on risk assets across the globe. So if we do look at some risk assets, let's first of all turn our attention to the stock market. We're going to turn here to the FTSE 100, and we've seen here now a fairly concerted turn to the downside on UK stock prices. We temporarily, you may recall, hit a level of 5,600 around the Japanese earthquake, and my comment at the time was that the market was uncomfortable down at those levels. It was an exceptional situation that drove asset prices that low, and we can see that the rebound was equally as strong. This move does feel as if it's got a little bit more momentum to the downside at the moment. I think the UK is largely driven by resource-based stocks, and if there is a sense that we are seeing a slowing in global demand, then commodity prices do tend to turn off, and the UK market may get hit a little bit harder than some other markets. So, as I say, commodities having a bit of a sell-off at the moment. Reflected, let's have a look at the oil price chart here. This is the price of WTI, which is the US version of the oil market. We had a big down week on oil prices. In one day we saw a $6 move, which is exceptional trading conditions in the oil market. And as we can see here now, we've had a very sharp decline in after that sort of Middle Eastern tension week, and now we seem to be resuming a downward trend back down to the $90 range. So ultimately good news that commodity prices are easing off at the moment, but it is having an impact on some US prices. Turning to the currency markets, a lot of what is happening in Europe at the moment is having two effects. First of all, it is impacting on the price of the euro, and it does mean that money is heading back towards the dollar and to some of those more safe haven markets. Just going to pull up quickly a couple of charts here to see the decline in the euro, first of all against the pound, and secondly, if if we look at the euro against the US dollar, you can see some weakness here that has impacted on the sentiment also. So the euro under a little bit of pressure, not too much pressure, I wouldn't say it's alarming at this rate. Euro still benefiting from buoyant conditions in Germany and France, but there's a little bit of tension coming into the euro at the moment and money heading back to the US. One other chart that I will pull up, reflecting this sort of move back to safe haven assets, this is the yield on 2-year treasuries, so this is the US government market, and this hit an all-time low this week. We can see here yields on 2-year treasuries hitting an all-time low. Generally across the world we are seeing much lower yields on treasuries, gilts and bonds, as investors are really moving more and more away from risk assets into safe haven assets. And what this is also doing is reducing expectations of imminent rate rises. We are seeing interest rate rises here in the UK now being pushed out by probably about a year from previous expectations.